Let's see what we get here on the economic calendar. First of all, if you guys haven't yet watched the podcast I've done with Adrian, this one here, I highly recommend. Okay. Why? Well, there's lots and lots of things that we have addressed it about the commodities. Okay. So if you don't know, Adrian is this guy here. So he is a philosophical, I don't know how to pronounce that, theology, and he's the founder of Agalpolis. That is a fund that trades futures on commodities. Plus, he trades physical commodities like corn. Okay, so he trade corn. He plant the corn, and then he hedged the risk through futures on commodity prices. So it's a very interesting talk where we address all the things that are happening around the world, especially on gold prices. Well, pretty much the whole podcast we've talked about the gold, right? So just pretty much gold, and I know you guys really like gold. So go there, so show some love, give us a thumbs up. That will help us to grow the channel, as well as give us more and more ideas to what to do with you guys. All right. Apart from that, I've posted a video today talking about the RBA. That's what we're going to talk today. And most importantly, I've posted a blog as well. So if you come on Learn and you go to Market Analysis, and then you can see this one, the RBA doesn't control Australia's economy. China does. That's interesting, right? Yes, China does control Australia economy, and it's a very short reading. Okay, not too big, anything huge. I usually do bigger ones, but I highly recommend you guys go and have a look at these. Okay, because you will understand then what I will try to show today. Now, let's go through the economic calendar, and then afterwards, we definitely will have the court, the commitments of traders, the institutional position on the currency. We'll separate this aside already to us later. Right. That being said, we can start on the economic calendar. Pretty much yesterday we didn't had anything. So we only had the, where is it here? Unemployment change, as well as the services PMI for Europe that came higher than expected. So that was good. That was good for Europe. That was good for Europe. Services coming higher means that there are people working. There are people, giving out service. So there's the difference between service PMI. Oopsie. All right, there's the difference between service PMI and the manufacturing PMI. Okay. So the difference here is that the service is it's someone it's doing a service. All right. So let's say I have a I'm a labor. Okay. I'm a labor. All right. So I go and build, I don't know, go and build a coffee shop. Well, I'm giving my service, I'm giving my hours through money. Okay. So someone is paying me, I don't know, 30, 40, 50, $100 an hour for me to build something. All right. So I'm providing a service to that person. Same goes for you servicing your car. The mechanic will provide a service to you, and of course it will have a cost, there being a monetary cost that you're going to have to pay, I don't know, $1,000, $2,000, $10,000. It just depends. So this is service. All right, someone giving the actual expertise on something, on a niche, and getting paid by that. Okay. The other thing is manufacturing. Okay. Manufacturing is completely opposite. Manufacturing is, okay, so actually, let me just write something here. Services mean people working, all right? Not that manufacturing doesn't mean that, but what I want to say by this is that there are people working on the economy. So if we have a higher services PMI, producer manufacturing index, pricing manufacturing index, producer manufacturing index, service, meaning that we have more people working in a sense. Okay. It's not a rule of a thumb because sometimes it doesn't work. All right. Now, manufacturing is the completely different. So I have a manufacturing business that I will manufacture kitchen, right? So I go at your house, I do the measure. Well, hopefully your wall doesn't look like that, but I go to your house. There's your kitchen here. I know that from this side to this side is 4 meters, and then from this side to this side, I know is 3 meters. And then you want to put a, I don't know, a island here. You want to do a little oven, oven on here, a cooktop on here, and another thing here. I don't know. This is your kitchen. You want to put a TV here. You want to do some lounging chairs here, your dining table. Okay. So your chairs. Okay. So basically, I go there and I will manufacture those things for you. Now, I can have those two things in one. That is, I can have the services that I will go there. I will take all the measures. I'm providing you a service. Then I will come back and I will do the manufacturing. Okay. So I can have those two ways, let's say like that. Okay. So basically, keeping it very simple, this is what services manufacturing means. I've explained this already, but there is some new people here, so hopefully you guys could catch it. Now, that was all yesterday. So today we had the RBA. We're gonna have a short look around on here. But yes, Australian dollar is falling. Okay. If we look, let me take this off. So if we look at the Australian dollar is falling, okay, so that was the release of, oopsie, sorry, that's not what I want. This was the release of the RBA monetary policy, sorry, the rate decision. And afterwards, on those two candles here were the monetary rate statement. All right, so we're gonna get in there in a second. Then we're gonna have tonight. That's it. We're not gonna have anything else. Tomorrow we will have the FOMC member Kashkari speaking. Kashkari, something like that. Sorry, as well as the Bank of Canada Senior Deputy Governor Roger giving a speech. We're going to have the European Central Bank non-monetary policy meeting. That's quite interesting. Nothing much will happen, but it's quite interesting. And then this is it for tomorrow. And then on Thursday, we have crude oil investors, not much. We had some Fed speaking, some Fed speeches. And then we have the Bank of England, 9 p.m. on Thursday, all right, rate statement. Rate decision and the interest rates meeting minutes as well. And then on Friday, we got the, where is this? Here, the GDP for UK, okay? And this is pretty much it. And then Saturday is just the normal things. So not at all, not a busy week at all, okay? We do have some central banks on the agenda. Like we just had RBA, we're going to have as well the Bank of England coming and deciding what they will do with the rates. Apart from that, this is pretty much it. All right, guys. So nothing too huge happening this week. Now, so let's go and address already the RBA. Okay. RBA. This one. And this one here. Okay, we're gonna need this guy on here, and we're gonna need this guy here. There we go. So this is pretty much, we're gonna have a look through this right now. But I wanna just make sure you guys hear that they haven't changed much. Okay, so let's go through it. As it's meeting today, the board decided to leave the cash rate target and change it at 4.25%. And the interest rates paid on exchange settlement balances and change it at 4.25%. Inflation remains high and is falling gradually than expected. Okay, this is, let's just start here. Let me grab my pen with this, that one. Okay, inflation remains high and is falling more gradually than expected. It doesn't have a huge impact on the market. Okay, it's just saying that the economy is doing better than what they expected in the sense of the inflation. Recent inflation indicates that inflation continues to moderate, but it's declining more slowly than expected. There we go. See, as I just mentioned, it's nothing that it's huge for the economy, as they say here, but it's declining more slowly than expected. The CPI grew by 3.6% over the year to March quarter, down from 4.1%, remembering that it was 7.8% on last year at the peak. Underlying inflation was higher than headline inflation and declined by less. This was due in large part to services inflation, which remains high and is moderating only gradually. Higher interest rates have been working to bring aggregate demand and supply somewhat closer towards balance, but the data indicated continued excess in the demand into the economy. So what does that mean? Well, pretty much means that the demand, meaning consumers, so let me grab my pen here. So this one here, meaning consumers, okay, basically are spending more than what they would like to. Well, I mean the RBA. So the consumers are spending more than what the RBA are willing to take it. Why? I've mentioned it already. More spending generates more inflation. Therefore, it's not good. Okay, it's not good because they are battling for the inflation to come down, and they're seeing that inflation is not coming down as they expected. Well, it's coming down, but not as what they expected. Therefore, they're trying to maintain the rates higher for longer to bring that aggregate demand and the aggregate supply somewhat closer to each other. So what it means by that is, so we have the Y here and we have the X here. Okay. So here we have, let's say, the demand. So the demand has a curve. We can call this the D. Okay. And then on the Y, we're going to have the supply. That is going somewhat here, let's say. Okay, so that's the S, meaning the supply. Here, it's called the E key. Okay, that is the equilibrium point. Now, what they want to do, what they would like to see happening is the supply coming down here and the demand, let me grab another color. Oh, that's all right. And the demand coming right here. Then here is the new E key. Okay, so you have to put the number 1, so it indicates that it's the second after the 0. So equilibrium point that is happening now, and the equilibrium point that they wish to would be happening. So just bear in mind, this is what they're trying to do. Okay, they're trying to bring the demand down, as well as the supply will come the economy has it, so it will work normally as normal. Okay, they don't have to worry about the supply, they have to worry about the demand, because higher rates of course impact the supply, but it impact even more the demand. All right, but that being said, let me not this one. There we go. Now, moving forward, coupled with strong domestic cost pressures, both for labor and non-labor inputs, conditions in the labor market have eased over the past year, but remain tighter than is consistent with sustained full employment and inflation at target. Remember, as I say, all right, RBA has a inflation target band between 1 to 2%. So they're very close to get the inflation under control. But remember, it's much easier to get inflation all the way from 7.8 to 3.6 where it is sitting right now, than 3.6 to 2%. Okay, this 1.6% is much harder to bring down than the whole 4.2%. Okay, why? Because when inflation starts, it's very inflated. Okay, therefore, any hiking on the rates, any how can I say that? Any push forwards the monetary policy will bring the inflation down, and this is why it is happening. So, I mean, yes, inflation is down, but it's not a big thing. Okay, they need to put at the target. Right. That being said, wage growth appear to have peaked, but still above the level that can be sustained given trend productivity growth. Meanwhile, inflation is still waiting on people's real incomes, and output growth has been subdued, reflecting weak household consumption growth. All right. Moving ahead, the outlook remains highly uncertain. Okay. When they say the outlook remains highly uncertain, they're pretty much saying this. Okay, they are data dependent. That is pretty much what they're saying. Okay. All right, let's go. The economic outlook remains uncertain. A recent data have demonstrated that the process of returning inflation to target is unlikely to be smooth. Oh, I didn't read that before. That's not good. That's really not good. This bit here, especially this phrase, returning inflation to target is unlikely to be smooth. That means a hard landing. Okay. Now, what does hard landing means? It's a technical term used by the economists to define a soft landing and a hard landing. Soft landing is when the inflation have been inflated, they've hiked the rates, and now they have to cut the rates while maintaining the inflation sustainable on a XY level, 2%, preferable at the target, and continue to have dual mandate. What is the dual mandate? Continue to have low inflation plus high laboring market. Okay, so people have to continue to work, otherwise it would be a catastrophe. This is what the RBA is saying that they won't be able to do. So that means a catastrophe. Okay, so this is definitely not looking good for Australia. Plus, it's not good for the Australian dollar as well, but we'll get there in a second. So the central forecast, so that's a very important line. So the central forecast, based on the assumption that the cash rate follows market expectations, are for inflation to return to target range of 2 to 3% in the second half of 2025. Let me highlight this. Inflation to return to the target second half of 2025 and to the midpoint in 2026. Wow. So basically in 2 years, we're going to have inflation normalized. Okay. In the near term, inflation is forecasted to be higher because of the recent rise in domestic petrol prices. That's completely true. We did have a huge rise on the petrol prices here in Australia. So I think the actual prices on like Shell, 7-Eleven, and the other gas station was like 230, 240, 250 even. Okay, but now it's sort of declining, but still have a higher petrol prices. Okay. And higher than expected services price inflation, which is now forecasted to decline more slowly over the rest of the year. Inflation is, however, expected to decline over 2025 and 2026. The persistence of services inflation is a key uncertainty. Is expected to ease more slowly than previous forecast, reflecting stronger labor market conditions, including a more gradual increase in the unemployment rate and the broader underutilization rate. I don't know what's this underutilization rate, but I can have a look later. Growth in unit labor costs also remains very high. It has begun to moderate slightly as measured productivity growth picked up in the second half of last year. This trend needs to be sustained over time if inflation is to continue to decline. At the same time, household consumption growth has been particularly weak as high inflation and the earlier rises in interest rates have affected real disposable income. In response, households have been curbing discretionary spending and maintaining their savings. Real incomes have now stabilized and are expected to grow later in the year, supporting growth in consumption, but there is a risk that households' consumption picks up more slowly than expected, resulting in a continued subdued output growth and a notable deterioration in the labor market. More broadly, there are uncertainties regarding the lags in effect of the monetary policy and how firms' pricing decisions and wages will respond to this lower growth in the economy at a time of excess demand and while the labor market remains tight. Now, that's not much saying through here. There's no much that they say, but still, they're not too confident that the rates have been fully affected into the economy. So that means that we may see higher prices on supermarkets. We may see higher prices on the consumer end. All right. So because if the rates haven't been yet completely filled fulfilled, let's say, it's not good. Okay. Now, going slower. There also remains a high level of uncertainty about the overseas outlook. While here has been improvement in the outlook for Chinese and US economies, and many global commodity prices have picked up, geopolitical uncertainties, including those related to the conflicts in the Middle East and Ukraine, remain elevated. We all know that, I guess. I'm assuming. Now, returning inflation to target is the priority. Okay, so that's the only priority pretty much of the RBA since they started to fight against the inflation. So returning inflation to target within a reasonable time frame remains the board's highest priority. This is consistent with the RBA mandate for price stability and full employment. So as I've said, they don't expect this to happen. Okay, so that's very controversial because look at that. There we go here. So if we look, like this, so we can see here, inflation to target is unlikely to be smooth. And then we look here, this is consistent with the RBA mandate for the price stability and full employment. This is the mandate for price stability, return inflation. Okay, so these two parts, pretty much, they don't go with each other. Okay, so if we get this, especially unlikely to be smooth, and then we get all the way down to here. Oopsie. Let me do it again. All the way down to here. This is not good because they're pretty much, I don't want to say that they're lying, okay, but they are sort of, lying, unfortunately, because look, when the RBA, when a central bank has the priority of consistent with the mandate of price stability, meaning that they don't want the prices to go high and lower, but they want a full employment on the economy, but they say that this isn't likely to happen, that's scary. Okay, continue. The board needs to be confident that inflation is moving sustainable towards the target range. To date, medium-term inflation expectations have been consistent with the inflation target, and it's important that it remains the case. Let me clear all. Now, there we go. Recent data indicated that while inflation is easing, it is doing so more slowly than previously expected, and it remains high. The board expects that it will be some time yet before inflation is sustainable in target range, and we remain vigilant to upside risks. The path of interest rates that will be ensure that inflation returns to target is a reasonable time frame remains uncertain, and the board is not ruling anything in or anything out. Wow. The board will rely upon the data in the involving assessment of risks. In doing so, it will continue to pay close attention to developments in the global economy, trend in domestic demand, and the outlook for inflation and the labor market. The board remains resilient and determination to returning inflation to target. Now, so if we look, to all of these, pretty much we've been reading this for 20 minutes now. What can you guys sort of I'm gonna say, what can you guys sort of absorb from this? Put in the comments. Do you think that they are bearish? You think that they are bullish? What do you sort of think? Hawkish? Sorry. Do you think they're hawkish? Do you think they're dovish? What sort of idea when you read these you have? Hawkish. Thanks, Steve. Who else? Only Steve. No one else. Okay. So they are neutral to slightly hawkish. Exactly. So it's neutral to slightly hawkish. Why not completely hawkish? A completely hawkish approach would make the market believe that it would hike rates again. But I would risk and say that they're sort of neutral to dovish. Why? Because they indicate that inflation is coming down on the pace that they want. So that means if inflation comes down to the pace that they want, therefore they will cut the rate sooner. Okay, and that yes, the economy is underperforming, but you know what I mean. Like, it's a very tricky situation. Very hard to read what they are expecting here. Okay, but anyways, so my opinion is that they are neutral to slightly hawkish, but there is some tons of dovish, but small tons of dovish, still more maintaining the rate than what they are sort of saying. Did we have the minutes today? Today. No, we don't. We have the monetary policy statement, but we don't have the. Oh yeah, we can have a look on the monetary policy statement. That's pretty interesting as well. But first of all, let's have a look on this other thing here. That is the RBA rate tracker. So that means that it's a sort of similar idea. Well, sort of similar. No, it's it's the same concept than the CME Fed Watch 2 that shows to us what are the market expecting for next month and so on. Here, it's not different. So we can see that in the 23 of April, you know, 100% was no change. 97% no change, 100% no change. So pretty much no one is expecting changes. And then we came up to the 6th of May. Now, if we look to here, the interbank cash rate futures implied yield curve, we can see that the yield curve, all right, the implied yield and the official cash rate are sort of to start to be cutting actually in September. Okay, because we are in 39 now. So September would be the first cut that the market is expecting to RBA to cut the rates. Okay, so that's not what the Fed is looking to. The Fed is looking to cut in November. Oh, remembering that it's the 2025, so next year. Okay, that's not good. As of the Fed is looking, where is September here, 5 to 525. So 50%, let's call 50% of the market is expecting a cut from the Fed in September. I think this year they will cut one time. Do you mean the Fed or the RBA, Aditya? I think you mean the RBA, right? Most probably. I don't think they will cut this year, to be honest. But it would be interesting to see. Would be interesting to see. Anyways, yeah, RBA, yeah. Let's see. Let's see. I'm more towards next year, because if they cut that would be a good thing. I'm not saying that I don't want this to happen. Of course I want. But it's a very, very hard thing to happen. Okay, but let's move on. So that's pretty much it for the RBA today. Now let's see what was the impact on the market that it had. Let me leave this here. Let's see what was the impact on the market. So as I've said, 15-minute chart. Right after the delivery of the news, that the rate decision, we had, this was the NFP last Friday. We had this drop from 66.26.3 all the way down to 66. It's pretty much 0.4 negative of a move of 0.4 negative. Now, do I think that this move will continue to go down and sustain it going down? Look, if it goes down, I'm more expecting it to stop somewhere on this level here. Okay. I've done a video today talking about that the RBA would pause and the market would go up. I did that was wrong. I was wrong. But that happens. So if the market decides to continue to go down, then it could come out somewhere around here and then start to move back up. Why I'm saying this? Now, this is where I'm looking, and this is what I'm saying about that. The RBA is not controlling the Australian economy. It's the Chinese. All right, it's the China that is controlling. Why? Okay, so let me show you something. Let me take these drawings off. Let me show you something pretty interesting. So this is the Hong Kong 50 index. All right, I'm gonna add line. I'm gonna add to the chart. On not a yellow, orange, we have the Hong Kong 50, and on blue we have the Aussie dollar. Let me put in a daily time frame. Mm-hmm. 4 hours would be better because it's too much data. Yep, there we go. Look at this. This is very, very similar, isn't it? Interesting, right? Interesting. So especially now, especially the beginning of the month, well, from month of April to now, it has been completely same. No changes at all. Okay. Even on here, we had this up move, we had an up move here, and then a down move, we had a down move here, and now an up move, we had an up move here as well, and a down move, and a down move. So that is interesting. Okay. Now, what I'm saying that the China controls Australian economy is, I've explained to you guys already about, where's my pen? There we go. Okay. Oh, that's beautiful. So the balance of payment, the BOP, plus import and export. Okay. This is Aussie and in China. All right. This is pretty much it. They have a big balance of payments. What does that mean? It means that Australia buys Chinese yuan, China buys Australian dollar, and they go from there forever. Why? Because they have to do the imports and the exports. And these, it's not the word manipulate, it's the word movement. It's a um, this generates a high inflow and an outflow of those two currencies. So those two central banks, the Chinese People Bank of China and the RBA, the Reserve Bank of Australia, do have a higher influence on the economy, but only China has a much higher influence on the Hong Kong, let's say, index, or even on the Australian dollar. Why? Now, why is this happening? Okay, why is this big move happening? Because if we just pay attention, that's a quite big move. Okay, let's see, from here to here, it's a 3.72%. Okay, on the Hong Kong 50. Now, if we look to the daily chart, let me take this. Let me just go for Hong Kong. Hong Kong 50. This one. Then I can take this off. Put into a daily time frame. Then go candle. Look at this. For the last year, well, basically, look, from the past 3 years, from here to here, it has been dropping. Okay. Now, why is this move happening so strong? Okay, because this is not a sort of a pullback. There is some reason behind this move. So what is the reason? Does anyone know? What do you think the reason is? If you've read my blog, you probably know why. No one? The reason is called, where is my pen again? The reason is called this is the reason. Real estate market. Okay. This is the solely reason of this up move on the Australian dollar plus the Hong Kong 50. So now you can sort of understand what I mean by that China is controlling Australia economy, especially Australian dollar, of course, because they do have their interest on us. Is that wrong? Well, nothing wrong with that. Nothing, it's completely normal. But can you imagine like that? Only the real estate market on China is getting better now, right? It's sort of getting better because it was very, very bad, and now it's good. So another thing, I go a little bit further now. Can you guys? I don't have this information. Maybe if I search on Google, because I can ask for. Let me search on Google. Cash flow on Chinese real estate market. Let's see if I can find this. Let's see if I have this chart. I really want to find it to show it to you guys, but it's probably I won't find it. Maybe if I go in images. Maybe this one. No. Cash flow investing on Chinese real estate market 2024. Yeah, I won't find it, unfortunately. I have it on my office computer, but it's not on here. I will send it on the Telegram group. But it was really, really interesting to see how the money, how much money was getting injected into the real estate market on China. So imagine a chart, right? I'm going to try to draw that for you guys. So imagine a chart pretty much going like this to this, okay, and even higher. So these was like 1,000, and now it's 10,000 just in few weeks, okay. So you can already understand how big this is becoming. All right, this is a snowball. So this is why I'm still believing on a midterm on a strong Australian dollar compared to the US dollar. Now, the third thing and last thing that I want to talk is that the US dollar is the opposite. Well, what's the symbol? It's something like this of the Aussie dollar. Okay. Oh, wow. That was a nice. Oh, a. Look at that. There's even looks like what's his name? What's the name? Um, uh, no, I forgot the name. That the game, the little guys that they look like this. They have like a little face. I forgot the name. Anyways, Among Us. Yeah, that's the one. It looks like Among Us. Yeah. Anyways, so if we look to, okay, let me take all of this off. Take this drop. Okay, so if we go for the US dollar index, maybe in the 4 hours. If we go for the 4 hours and then we add Aussie dollar index, I have to find it. AU index. Nah, they don't have it. That's all right. So Aussie dollar USD. Then I search, put it here, and then I put this as a line. So we can see, right? We can see that the Aussie dollar is completely different approach to the US dollar. It's just the opposite. So whatever the US dollar does, the Aussie dollar will do opposite. And whatever the Australian dollar does, the US dollar will do the opposite. So if, I know it's a bit confusing, but just if, let's say we have Aussie dollar going up, US dollar will go down. If we have US dollar going up, Aussie dollar will go down. Okay, so that's pretty much, it's a cross. Okay, so that's kind of interesting on what's happening with the Aussie dollar. Now, that being said, if we look back to the Australian dollar, if we come back to the Aussie dollar here, where is this? There we go. I'm expecting a move up to this area, to the 67. Okay, so the 67. So that's what I'm expecting. As I say, it can go down here, but then I bounce back to this area, hoping breaking this area here, and this is a support, and that's a uptrend even down here. Okay, so that's pretty much what I'm expecting for the Australian dollar. Stronger Aussie dollar. I know, pretty crazy, right? But as I've showed, I've mentioned multiple times, and I guess it's a time to wait and see at this moment. Now let's move on and see the commitments of traders. If it loads, there you go. So on the US dollar, we didn't have much change. Still a very big percentage shorted, all right, very big percentage on the negative side. So negative 41.4. The Canadian dollar is still negative. So still a bit of increased from the last one, from the negative 20, but now it's on negative 23.4. JPY didn't change, literally didn't change. The New Zealand dollar 15.5, so a bit stronger than last week. CHF still quite similar, 7.5, well, less, negative 1%. Euro, getting there, negative 3.5. GBP, negative 1.2. And the Australian dollar, negative 14.8. So again, what is moving Australian dollar is China. Okay. That's pretty much it from me today, guys. Any questions? We're not going to be looking all the pairs. I was just more focused on that. But you guys have any questions? No questions? All right then, guys. Thank you so much for today. Again, if you have any question, please submit through the Telegram. And GBP USD, GBP USD, GBP USD. I had a target already set, that target, but there you go, the 1 hour. That was the first target here. It didn't quite got hit 26,500, but now I'm looking to trade it down this week, to trade it down. All right. If it breaks this, then it probably can trade down here and then back up. Maybe. Okay, maybe. Euro Aussie. Euro Aussie, again, I'm expecting a stronger Australian dollar. Therefore, I'm expecting the Euro Aussie down. Okay. I'm expecting it to come down. Stronger Aussie dollar. All right. All right, guys. Have a good one. And we catch up tomorrow on the video and on next Thursday. On this Thursday. Next webinar on Thursday. Take care. And we chat soon. All right, guys. Thank you. Bye-bye. Have a good week.